everyone, welcome back to Mike and his whiteboard. My name is Mike, this is my whiteboard, and today we're going to talk about my 3 favorite strategies for my IRA account. So when we're talking about IRA accounts, generally when it comes to trading personally, I've got a theme, and that theme is to accumulate stocks with different underlyings depending on what I've got my assumption in, but at the same time I'm going to reduce my cost basis. One thing to know with IRA accounts is that there are some restrictions. We don't have that additional leverage like we do in margin accounts, and we can't trade naked calls, so we can't short a naked call. We can buy naked calls if we want to, but that's not really what we do here at I'm going to break down my 3 favorite strategies for my IRA account. So let's get into it and we'll break these down. So again, short naked calls, we cannot sell them in an IRA account, so that's the #1 restriction with IRA accounts. So with that said, a lot of the popular strategies like straddles and strangles, we can't really do those, but we can do variations of those. So I've got my 3 favorite trading strategies here for IRA accounts, and the #1 is definitely going to be the short put and turning that into a covered call. You might hear Liz and Jenny refer to this as the Wheel of Fortune. My second one is basically doing a synthetic straddle or strangle, and we can get into how I can do that. And last but not least, the big or jade lizard. So depending on my assumption and the product size, I might do one or the other. So let's start with the first one, and that is going to be the short put and turning that into a covered call. So I'm going to break down some of the benefits for you and some of the cons as well on the next slide here. So with a short put and turning that into a covered call, if we're actually assigned stock, it's a great cost basis reduction strategy, and it gives us the ability to be neutral and bullish at the same time. So over here to the left, you can see I'm selling a put. Let's say it's a 95 strike, and the stock price is currently at 100. So let's say I sold that put for $1.50. Now, let's say that the stock actually ends up going down. So even though I was neutral to bullish by selling that put, the stock ended up going down and I was assigned on those shares. So let's say I own those shares now at the 95 strike, and let's say the stock's at 90. Right now, what I would think of doing is, instead of owning those shares outright, I'm going to continue to reduce my cost basis further. So that's when I would turn it into a covered call strategy. So let's say I'm assigned these shares at 95, stock's at 90, and I'm going to sell that 100 call for an additional 50 cents. So let's talk about why this might be more beneficial than just buying that stock outright when it was trading at 100. So if I had bought those shares, those 100 shares, when the stock was trading at 100, my cost basis would be $10,000 because I would have to pay that money up front to buy those shares. And especially with an IRA account, we don't have that additional 2-to-1 leverage when it comes to buying shares. So with a margin account, I would only have to put up $5,000, but since we're in an IRA and everything's cash secured, that whole $10,000 would be taken out of my account. Now, instead of doing that, I decided to sell the put and then turn that into a covered call when I was assigned. So what I've effectively done is reduce my cost basis $700 by doing that. So we can break down how I did that. So I'm selling the put that's out of the money, and with puts, again, out of the money is below the stock price, and in the money would be above. So I'm selling that put at 95 for $1.50. So I'm receiving that $1.50 credit. And if we're just looking at the top portion there, my cost basis at that time, or my break-even point, would be $93.50. Since I collected that credit, I can just reduce that from the strike that I selected. Now, I was assigned on those shares at 95, and I've already collected that $1.50 credit of extrinsic value. So even though the stock's trading at 90, if I can sell that call for 50 cents, I basically take my 2 credits, so 50 cents here, $1.50 here, which totals to $2 or $200 in the options trading world, and basically weigh that against my strike. So I would be assigned shares at 95, but I had collected $200, which I can reduce my cost basis with. So really my cost basis is at $9,300. So you can see this gives us a lot of benefits, and we're going to talk about them over here. So the pros for this would be cost basis reduction. As you can see, my cost basis is drastically lower than if I were to have bought those shares outright. And even though I was directionally wrong, my loss is much smaller than it would have been if I bought it at 100. I would be seeing a $1,000 loss here if I had just bought those shares outright. But instead, I'm only going to be seeing a $300 loss. Secondly, my pop percentage is going to be much higher. So with selling puts instead of buying shares outright, When I'm buying shares outright, I need that stock to go up to be profitable. But when I'm selling a put, I can have that stock stay the same, go up, or go down just a little bit, but not past my break even, and I would still be profitable on the position. So because of that, I've got 2 out of 3 ways to profitability, and my probability of profit's going to be going up. The only knock on this would be that it's got limited profit potential. So let's say we had a tail event where the stock went from 100 to 130 in a couple of days. While this normally doesn't happen, the only time I would be more beneficial with that situation is if I had bought those shares outright, because then I would receive all the profit on that. But since we can't ever predict that, what we prefer to do is go ahead and reduce our cost basis first and get a high probability trade on the board, and we'll deal with whatever happens later. So in this case, doing this strategy, the short put, turning it into a covered call, is going to help my downside risk. It's going to give me a high probability trade, and it's going to give me more ways to be profitable. So I'm going to be choosing this strategy against buying shares outright every day of the week. So let's go to the next slide, and we'll talk about another strategy, which is going to be the synthetic straddle and strangle. So as I stated before, we can't sell that naked call in an IRA account. So there's things that we can do to mitigate that and pretty much be creative and turn a straddle or strangle into something we can execute in an IRA account. So what we need to do that is basically purchase wings instead of having that short naked options trade. So one cool thing we can do is basically measure the buying power reduction and then weigh that against the wings that we purchase. So the DOE platform basically takes the margin account and it basically calculates what the buying power reduction would be. So let's say I've got a short strangle loaded, which you see here on the DOE platform, and I'm selling an out of the money put, also selling an out of the money call, which gives me that profitability range if the stock price stays within those short red options below here. So let's say I'm looking at selling that strategy, and let's say I'm looking at a buying power reduction of $1,000. What I can do is buy wings that are far enough out to replicate that same buying power reduction and effectively give me a very similar trade. So let's say I've got a estimated buying power reduction of $1,000 in a margin account. If I go 10 points wide or 10 points higher on the call side and 10 points lower on the put side and look to buy those very wide, far away wings for a couple of pennies, it's going to give me that same rough buying power reduction. And since these wings are only worth a couple of pennies, it's going to give me pretty much the same functionality as if I were trading that short strangle naked. So the pros here are that we've got wide wings that are pretty much not worth anything, so it's not going to hinder our probability or our max profit too much. And another thing is that it gives us an ability to be neutral in an IRA account where most people just buy stock, which is completely bullish. So it gives us a strategy that gives us some neutrality, which is what we're all about here. And basically a straddle, as you see down here, is just another way to deploy that same strategy. We're going to have a higher profit potential with straddles because there's a much lower chance that the stock price would actually pin these short options, which is exactly what we need to happen to reach that full profit. But since we're selling at the money options instead of out of the money options, we're going to be collecting a much higher value here while still maintaining roughly the same probability of profit. So some cons to both of these strategies is that we will have a higher buying power reduction than if we were to compare the strategy to a margin account, but at the same time, there's really not much we can do about that with the restrictions that we know about with an IRA account, and everything has to be cash secured. So another con might be a lower probability of profit. When we're comparing this strategy to, let's say, a naked strangle or a naked straddle, it might have a lower probability of profit just because we're buying these wings. Even though the wings might be worth a couple pennies here and there, any reduction in our max credit that we're receiving is going to narrow our break-even points, which is in effect going to reduce our probability of profit. So these are some things to keep in mind, but these are definitely some of my favorite strategies for an IRA account. So lastly, what we're going to be looking at is the Big Lizard and Jade Lizard. So one thing that we can do in an IRA account is deploy strategies like this that give us that neutral to bullish assumption, but also give us the ability to acquire the stock if that's what we want to do. So when we're looking at big and jade lizards, you'll see it's very similar to a wide wing strangle here. So all I'm really doing is removing that long put over on the left side. So what this does is it's going to give me a higher credit than the previous strategy, but it's also going to skew me more towards the bullish side. So if you missed my previous whiteboard on jade lizards and big lizards, definitely check it out by clicking the Find Shows page at the top. And then scroll down to Mike and his whiteboard and you'll see it listed there. But essentially what we're doing is we're selling this total spread for a larger credit than the width of the call spread. And in doing that, it gives us no risk to the upside, which is why you see this arrow here exceeding the calls. So as you can see, for one of the pros is that if we set it up correctly, we have the ability to profit through the call. So if the underlying does end up exploding, we can still be profitable, but we're still going to have that max profit if the stock is between our short strikes at expiration. Again, this gives us an ability to be bullish to neutral instead of just neutral. It's going to have a high probability of profit because anytime we're selling out of the money options and giving ourselves a range to be successful, we're going to be in a high probability of profit scenario. And lastly, we're going to be reducing our cost basis regardless of what happens. So just like the original example where I was selling a put, if I add this call spread to it, I'm going to be collecting right around that same amount. And if the stock ends up going down, my cost basis will still be lower than if I had just bought these shares outright with that same bullish assumption. And again, another con here that you might want to consider is that it's going to have a higher buying power reduction, but that's because of the restrictions in the IRA account. So as we were talking about before, IRA accounts are all cash secured. So if I'm selling a put here, since I'm not defining my risk on the downside, it's going to take out that full value. So if I'm looking at selling a 50 strike put for whatever amount, the buying power reduction is going to basically be the same as if I were to be buying 100 shares of stock. It's going to be a little bit less since I'm collecting that credit and it's going to be calculating that. But the buying power reduction will still be relatively high. But still, since we're reducing our cost basis and entering a high probability trade, again, I'm going to be choosing this over buying shares of stock every day of the week. And lastly, the big lizard is going to have a better probability, or I shouldn't say probability, but a better chance of making more money. And again, that's because since we're selling at the money options on the same strike, if we're really lucky and the stock price actually pins these options right at expiration, since we collected a much larger credit and we're going to see a higher probability or a higher profit potential, then it gives us that ability to have more P&L with this trade when we compare it to the jade lizard above. So this has been a lot, so let's wrap it all together with some takeaways here. So the number one takeaway we want to take away here is that IRA accounts do not allow you to sell naked calls. That doesn't mean that we can't deploy strategies such as strangles or straddles. We just have to be creative and purchase wide wings if that's something we want to do. Secondly, strategies are going to revolve around cost basis reduction. So for me, again, personally, I like to rotate my strategy around accumulating stocks in my IRA account, watching that grow over time, but continually reduce my cost basis because at the end of the day, I never know what's going to happen with the market. I might have assumptions, but I know that reducing my cost basis by collecting a premium is going to help me in the long run. And lastly, long wings are designed to reduce buying power reduction, not infringe upon profit. So when I'm talking about buying very wide wings for a couple of pennies, I do mean a couple of pennies. So we're basically trying to reduce our buying power reduction, but not infringe upon our profit potential, because the more we infringe upon our profit potential, the lower our probability of profit will be. So hopefully you've enjoyed this. These are my 3 favorite IRA trades. If you've got any questions or feedback at all, shoot me an email at support@doe.com, or you can tweet me at DoeTraderMike. Until tomorrow, we'll be back at the same time, so have a great night.
What's up, everyone? Thanks for watching our video.
If you like this video, give it a thumbs up or share it with a friend.
Click below to watch more videos, subscribe to our channel, or go to our website.